Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Julian Fosh, co-manager of the Liontrust UK Growth Fund, to give his 3 stock picks. Hi Julian.
Hello.
So what's the first stock today?
Rightmove is a company that's done very well for us over the long run and which we think will continue to do very well. Essentially, our process is about finding companies with very strong intangible assets deriving either from their IP or very strong distribution or high levels of recurring revenue. And Rightmove fits that mould. The point of that is to, hopefully, companies that have that will have an effective barrier to competition. It'll allow them to earn stronger returns for longer than the market thinks. And also, if people do attack these attractive franchises, the company should be able to fight them off. So turning to Rightmove, and it's obviously a company all of us know, earns very high returns from its franchise and has seen off 2 attacks in the past, most recently from on the market, where Rightmove has emerged stronger than ever. And actually perhaps before that, several years ago, from Google, who attempted to move into Rightmove's space but then gave up within a year.
And what's the second stock today?
Our second one is one that we've got wrong, but which we think is starting to come right now, which is Pearson. So again, relating this to our process, I mean, Pearson's got a terrific distribution footprint. It is the global leader in education, educates over 100 million people worldwide. Share prices performed poorly last year, 3 profit warnings notably, and we think that's because the education cycle in North America has taken a much longer to turn than we thought, or indeed than Pearson's thought, prompting a restructuring. The thesis, of course, is that if you have a strong market share, that will ultimately enable you to earn excess returns. Pearson have very strong market shares in some segments, 60% or more in North America, and the challenge for them is to translate that into achieved superior earnings. The challenge is complicated by a transition to digital. But we think that the management's implementing a brave and correct strategy there by selling off trophy assets, such as the FT last year, and reinvesting that in the core proposition.
Of course, Pearson is one that people have felt strongly positively about for some time, but the share price has disappointed. I suppose one thing about being a long-term investor is you just sit tight through these difficult periods. But you say you've got it wrong so far, but you believe it will come good. Is there a timeline that you stamp on that as a fund manager? At what point do you just say, you know what, we're done?
It's always on a case-by-case basis. There is no substitute for monitoring it on an ongoing basis, talking to the management, seeing how they're progressing versus plan. I think I said bravely, Pearson itself is committed to providing much greater disclosure by 2018, so that's a natural timeline for us to follow with them. So far, so good this year, though.
And what's the third and final stock?
Our third stock is an interesting stock, Halma. So Halma is a company that is engaged in environmental protection and safety, and again has protected niches by virtue of that. 4 major divisions, well spread globally. A very quiet company, never flashy, never producing amazing uplifts in profits, but just quietly, year by year, produces steady returns. And that's been reflected in one of the best unbroken dividend growth records of any company in the UK market. So every portfolio, I think, needs quiet, stealthy plodders. And Halma is one of those.
Julian, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.